Alright. Hi everybody. Welcome back to Liberator Trading. I know it's been a minute, but first, I just wanted to ask you if you ever heard of an indicator that could possibly tell you where traders are too fearful, too greedy, or when the market is maybe about to reverse from a certain position. I know that there's the greed fear index that people look at, but today I wanted to focus on the put to call ratio. There's a couple of different symbols, but we'll be working on $ CPC. This is probably one of the important indicators in the entire market. It helps you know if you know how to use it correctly. If you know, it can help you avoid buying at tops, maybe even during the panic selling bottoms. It can give you a better entry for maybe longer term trades or trying to time the market, as a lot of short term traders do. So in this video, I'm going to explain to you exactly what the put to call ratio is, how to read it, what the levels are that matters, and the mistakes that most traders make, and maybe share some real-time examples and share some real-time examples as well. So hopefully by the end of the video, you'll be able to understand what CPC is and the put to call ratio, and just another tool to add to the toolbox there in us understanding how to read the markets. So what is the put to call ratio? Well, put to call ratio, simply put, is how many put options are being traded compared to call options. So a simple explanation of that is here. Let me share my little chart, my little here. So we've got CPC. It's just total put volume divided by total call volume of the options in the marketplace. It shows kind of how traders are positioned and how they feel. So for example, if you have 1 million puts being traded to 1 million calls, that would be a ratio of 1, which means that pretty in line. If you have 2 million puts to 1 million calls being traded, the ratio is 2.0. And then obviously if it's 500,000 puts being traded to 1 million calls being traded, that ratio is 0.5. So the ticker that we're going to use is $CPC, which is the total equity put to call ratio. There's a couple different versions, but we won't focus on those. So let's go into the levels that matter here. And I guess the biggest thing, before we go into that, it just kind of gives you an idea of what the crowd psychology is. So the important thing to understand is that the push to call ratio typically is used for contrarian, um, to see where tops and bottoms are to go the opposite direction. So when everyone's too bearish, the market often bottoms. When everyone becomes too bullish, the market often tops. Why is this? It's because by the time everybody's already buying puts, most of the fear is already priced in. And by the time everybody's aggressively buying calls, most of the optimism is already priced in. So instead of following the crowd, we want to look for extremes. Think of it like everybody at the party is standing on one side of the boat. Eventually, the boat tips over because there's too much weight on one side and everybody goes in, but maybe a couple of people, they don't fall in because they're on the other side. So the put to call ratio help us seize when too many traders are leaning too far in one direction. So these are the levels that matter. And you can take a screenshot of this, write it down for yourself. These are the rough zones to pay attention to. Below 0.70, so pretty extreme on the bullish side of that. So you might be, or it's a contrarian, might be bearish at that point. 0.7 to 0.9 is bullish. 0.9 to 1.10, typically pretty neutral. I would say in that range, a lot of people will say 1.10 is starting to lead into fear. So between 1.1 and 1.3, you're going to be bearish. Extreme fear is going to be above 1.30. Remember, this is total in the market. Now, you know, these aren't exact numbers; they're just ranges. But if you see like the put to call ratio spike to 1.2, 1.3, or even higher, typically there's some panicking going on. So if you start to see higher readings, that means panics. But historically, those are often moments when the market's close to a short-term low. On the other hand, when the put call ratio drops to 0.60 or lower, traders are usually very optimistic and often complacent. So these are the moments where you want to be cautious. So here's a basic framework for you. High put to call ratio is going to be fear. So potential bullish contrarian signal. Low put to call ratio is going to be greed. So maybe it's a contrarian signal. When everyone agrees, markets usually reverse. Could be for a brief moment in time, could be longer term. We don't know. Just some examples here, just for your reference. In March 20 of 20, CPC got above 1.60. It marked an extreme fear and a market bottom. January of 2022, CPC neared 0.55, marked complacency and a market top. We'll go into that a little bit later, but first let's show you how to get it going into this, and maybe we can look at some examples. So here we've just got SPX. 'Cause it's broad market basically. Most people look at SPX to see what the market's doing. And Thinkorswim up here in the top, if you don't know how to use these little boxes here, I would highly advise you to start using them, but we're going to drop one down in here, and we're going to type in CPC. So let's open it up to 1 year. You're going to want to change it to a line chart. You're not going to want to use candles because we want to look at the close prices. You can look at what's going on in the day, and you can use that for daily signals. But I'd like to show you just normal potential signals here in general. So going back, let's go 2 years actually. Yeah, let's go 2 years so we can kind of see maybe the tariff stuff that happened last year. All right, 2 years. Okay, let's just grab 2025. Let's look at 2025. Look at 2025. So obviously 1.2. I use 1.2 and 0.7 as my extremes. So you can see we actually started closing. We closed above on 4.7, which is here. So 4.7, my days might have been a little bit off there, but that's okay. Let's just go this way slightly. See if that, there we go. So 4.7, we had to close at 1.24. That's this candle right here. And then what happened after that? Well, that marked the bottom. And so then we started to go. So yeah, this I know it says 0 up here. This is the 7.3, which is this day right there. As you can see, we're pretty much all calls. There weren't a lot of puts going on. Could have been a misread as well, but then we pulled back a little bit after this huge run up after this breakout. Then we pulled back. Then we hung tight. We can go back even farther. I mean, you can see these right here. Look, let's keep going. Yeah, we'll stick here. But as you can see, we've got, this is 1224 down here. Where's 1224? 1226, 1224 is here. So if you line that up, we're pretty bullish. And then we faded that move short term. Then you've got 1129. I bet you 1129 is going to be somewhere over here. Where is it? 1129. Yeah. 1129. We started to push up, could have just been a thing, and then we eventually did fall here. So you can see it doesn't always happen right away. It's just giving you an idea of what could be coming into the future. 11.4. So 11.4 is up here. Actually, sorry. Yeah, 11.4 is down here. And then we get really high bunch of puts, and then it shoots up here. Let's keep looking. Let's see, what's this day? This is 7.3 of 2024. Let's go find out. 7.3, 2024. So 7.3 is right here. Extremely, like I said, just could have been a weird read there, just happening in the day. But we pushed up here, pushed up, and then we came down. Let's see, what's this day? 8.5. Here's 8.5 right there. Just 1.27, and there's the bottom. So as you can see, I mean, it does appear that it works pretty well. Now we can even pull this up on the weekly, maybe go a little bit longer term. So here is this day, 1023. This is 1120. 1120, we got pretty bullish out of that run right there. You can see right there, 1023, 1023, poop. It also helps to understand what the longer term trend is as well. I mean, as you can see here, this downfall this little precipitous fall that we've been in, actually, if you go to the year, 1 year, 1 day, we actually haven't seen anything crazy happening. Like as far as the closes with the put to call ratio. Now, if you went like this and you went to 20 days, 1 hour, let's just do that for fun, right? Even then, nothing crazy is going on. Maybe you go 5 days, 5 minutes, just to see if anything crazy is going on internally. Not really. I mean, we've been pretty neutral inside of there. See, even with these crazy moves that have been happening, it's actually pretty normal in the market right now. So let's bring back my slides here. So other tools just to help you see it. Use SPX with price levels. Use tick for the breadth in the market throughout the day, what's going on in general. Use VIX for the fear. Follow the larger trend. We don't want you just sitting out there only using this. You have to, it's just giving you a picture, a snapshot. Okay, this is where things are going on right now. This is what's happening. So you can't just look at an absolute level, but you can watch intraday spark spikes. So like, let's pull this up again. Let's do 10 days, 30 minutes and see if we can find anything that happened throughout the day. Let's see here. Let's go to candles because we'll be able to see some spikes here. Actually, let's go 20 days, 1 hour. Yeah, it'll just help you see some things. So you can use it for intraday spikes, right? So here's Wednesday, 318. Got a huge spike here at the beginning of the day. So lots of puts, huge spike here. Yeah, we pushed down, and then after that, it started to pop up. And we go 10 day, 30 minutes. 10 days, 30 minutes, just to give you a little bit better picture. So here's Monday. Lots of puts. So you could say, oh, in this candle, maybe we're going to have a little pushback up into it, which we did. We closed down here, and then we had the spike up there, closed down. Right, it's not going to be perfect signal either. But another thing you could include in here is you could say, like you could pull up let's pull up another one down here. We'll just pull up some of these. Let's just go tick. You can pull up a tick. What are we on? 10 days, 30 minutes. So you can pull up the 10 day, 30 minute thing. You can say, okay, what day was this? This was Monday. So let's look at Monday. So you got a really high reading pushing up at the same time on tick. We touched above way above 1,000, but we didn't close below it. So you could say, okay, we got a lot there. And then we tried to push back up into it. We couldn't get the momentum, and then we came back down. Another thing you can use as well as the Vold ratio, which just shows you volume up, total market volume down and up, right? So maybe we weren't going to go bearish for very long on Monday because we actually had upticks here. We had lots of nicey tick pushes up here on Monday into the positive 1,000. Yeah, we closed down here. Then we got a bunch of negative ticks reading into here, and then eventually we ran up. So if you put it into a big picture, it can start to help you see what is going down in the market. So once again, just your recap here. So if you're using Thinkorswim, it's very easy to add this. You can build this little box thing, or you can just look at it this way with just these two. I'd go year to date, and then I'd use this as a line chart to see the closes, because those are going to tell you when the market's probably going to switch and go a different direction potentially. That's what I would do. So we've got 0.7 bullish extreme, 1.2 bearish extreme. Once again, you don't want to stare at a raw number all day. You want clear zones. So this is market's optimistic, market's too fearful. And you could create alerts in here showing when that it goes above it. Like I'll show you. So you can go to Market Watch, you can go here, type in CPC, and you can add a study alert. And you can say, let's go into here. Let's see. Where is it? It's not what I wanted. Yeah, it's fine. You can say close is greater than or equal to 1 from 1 bar ago, which is fine. Or you can just say close is greater than or equal to, you can just say close is greater than or equal to 1.2. And you can add, you can create a regular alert for a crossover when it goes back over, cross back over there. And then what you would do is you would just hit create. And now it's going to say that it's false. And if it triggers above it, it'll pop in there. And you can do that for 0.7 as well. Now, I don't think you need to do that because if you're going to just be watching this daily, just kind of see where we are. Like here, we started to come down and maybe get a little bit too bullish, obviously. But as you can see, it kind of sticks in between this 1.0, 1.7, a little above 1.2. I'd use 1.2 there. But I mean, if you go back, let's see. Let's go back 15 years and see what we can find. 15 years. Let's go back into 2020. Let's see what's going on in 2020. So here's 2020. Oh, sorry, 2020 is back here. Yeah. So you can see 2020, look at this. Starting in February, we started to get those readings up here that there's a lot of puts. So you got 228. There's 227, maybe come back down, come back in on 3.3. Then we started to push up. But as you can see, there's 3.9. We actually started to dwindle here and come back into reality. And then eventually there was a market bottom. And it's not going to be perfect timing, right? No, no way. But here's 9.3. Let's see if we can find 9.3. So you had 9.1, which was this day right here. And then we eventually came back in. Let's look at this, 11.30. 11.30 is going to be right there. So you had kind of a push down uptick, and then we pushed back up, and then it came up. Then you got 12.24, which is going to be here. So you can see, oh, we aren't going to actually fall. Maybe we'll push back up. And that's exactly what happened. As you can see, the market, if the market's going up, it's kind of works well. That's what my 2 cents were for today. That's all I wanted to show you is this put to call ratio. Go learn about it. Go look at it on a chart yourself. Let's see here. Let me put some common mistakes in here that I want to go over before I go. So you've got CPC, don't use it by itself. Don't fight the trend. You're ignoring confirmation and you're using CPC without a plan. So it's a sentiment tool, it's not a trading strategy. Never buy just because it's too high, never short because the ratio is too low. You still have to need price action, levels, you need confirmation. Using the wrong time frame, it's short term. Over the next couple days, what's going to happen? It's not very useful for predicting what the market will do 3 months from now. It can help you maybe start to position moving forward, but it's really going to give you that short term. Okay, in the short term, we're going to move up here. In the short term are going to move down potentially. Um, in bear markets, the put to call ratio can stay elevated. Bull markets, it can stay lower than normal for weeks. Don't blindly use fixed numbers. If it's sitting around like 0.5, 0.85, then all of a sudden there's a spike to 1.30, that matters. That's why we want to look for the spikes and the closes. But if it's been trading above, it's like, for example, like these spikes here, really abnormal for the closes, really abnormal. See, those would catch your attention. Or like we've been down here and then all of a sudden we come up to 1.6, maybe that's a little bit more meaningful. So the put call ratio, it's pretty simple. It's very powerful to understand market sentiment. When traders become too fearful, that creates an opportunity. When traders become too greedy, also can create risk. But don't use it by itself. Use it with price action, support and resistance, other market internals that you like, market trend. If you do that, hopefully you stopped reacting emotionally to some of these weird moves that happen and you start to understand what the crowd's really doing.